ticker symbol STX. We're looking at Seagate today as a subscriber request. Currently, they have a very high dividend yield coming in at about 5.1%. So that is crushing the dividend yield of an S&P 500 ETF right now. But we want to look at the business's fundamentals today to determine whether or not that dividend yield is potentially going to be sustainable for the business going forward. Currently, Seagate is trading for $54.71 per share. Over their last year, their stock price is down 46%. Over 5 years, however, Seagate is compounding at a rate of 6% annually. Over 10 years, they're compounding at a rate of 7% annually. And over the last 18 years, Seagate is compounding at a rate of about 6.5% annually. Keep in mind that they have been paying a healthy dividend for most of this period, and so that dividend yield would be in addition to these compounded annual returns. Seagate is trading only $7 above their 52-week low. They're down by about half from their 52-week high. Currently, about 5.5% of their shares outstanding are sold short, and they have about an $11 billion market cap. For additional background about the company, Seagate is a leading supplier of hard disk drives for data storage to the enterprise and consumer markets. It forms a practical duopoly in the market with its chief rival, Western Digital, and they are both vertically integrated. The company sells its products primarily to original equipment manufacturers, distributors, and retailers. Seagate Technology Holdings was founded in 1978 and is based in Dublin, Ireland. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist approach of 6 standard financial metrics to come to a holistic and beginning understanding of Seagate Technologies based off of their business fundamentals. So this analysis is a work in progress, and it's an opportunity to learn in public. It will continue to improve and get better over time. So with that said, let's get right into today's analysis. Starting with some of the key aspects of a potential long thesis on the business, Seagate has maintained a trailing 12-month dividend yield above 3% every fiscal year since 2016, making it a leader among technology stocks. It's expected that advancements to larger capacities and new technologies like HAMR will modestly expand Seagate's mid-cycle gross margin, and it's thought that strong demand for Seagate's nearline drives will power mid-single-digit top-line growth in the short term as enterprises look to store the growing amounts of data that they generate. Some of the key points of a potential short thesis for the business: it's not thought that Seagate's modular live profile will be able to generate enough demand to offset a cyclical or secular downturn in HDD drives. Seagate has a concentrated portfolio focused on enterprise mass capacity drives, and it's thought that if enterprise SSDs reach cost parity with HDDs, it could spur a steady decline in the firm's sales and profits. It's also thought that the HDD market is commodity-like and cyclical, leaving Seagate vulnerable to market pricing declines that can shrink the top line and sink margins. So that's a potentially balanced perspective on both some of the qualitative aspects around the short and a long thesis for the business. Now let's dig into their financials. So starting off with our first metric, we want their average return on capital over the last 5 years to be above 14%. So there are 2 major reasons for this. The first is that the average publicly listed business earns about a 7% return on capital, and the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. So when we combine these 2 together, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average when we look for a 14% benchmark here. So over this time, Seagate has earned very high returns on capital. Their lowest returns were more than 3 times better than that of an average business, coming in at about 23% in 2019 and 2020. They've increased their returns on capital since 2020 and averaged out over this period. They're earning about 26% returns on capital, so almost 4 times better than that of an average business and nearly twice as good as the metric we're looking for. Additionally, over their last 12 months, they're earning about 25% returns on capital. So these are strong returns for Seagate, and this is a check on metric number 1. Next up for metric number 2, we're taking a high-level overview of the growth of the business. We're looking for 5-year growth in their revenues, earnings, and free cash flows, and this metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. We're also including their last 12 months worth of numbers here. So over this time, even though it looks like they've slightly grown their revenues from 2018 until 2022, over their last 12 months, their revenues are actually down 5% from where they were at. Additionally, their earnings are slightly down, although they're basically flat. And probably most worrying is that over their last 12 months, their free cash flows are down 42% from where they were at in fiscal 2018. So all 3 of these are down, meaning that this is an X on metric number 2. It's especially concerning that their free cash flows are down so much because free cash flow is basically the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted backed by some reasonable interest rate is ultimately what that business is going to be worth. So a business can use free cash flows to reinvest back in their business, make acquisitions, pay down debt, pay dividends, or buy back shares. It's not good to see that that's down as well as all three of these. And so again, this is our first X on metric number 2. Next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking for earnings per share growth over the last 5 years. So over this time, we learned in the previous metric that their earnings are basically flat. However, their earnings per share have grown by quite a bit, nearly 25% over this period. And that's because Seagate has repurchased about 25% of their shares outstanding. This is potentially a great sign for long-term shareholders in the business because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that business. And when a business buys back shares by decreasing the amount of stock that they have outstanding, they're increasing your ownership percentage in the business, which is ultimately going to increase the percentage of the business's profits that you're entitled to without you having to spend a dime. So it's almost as if Seagate were making a partial acquisition of itself over this period. And just like with any other acquisition, we want a business to get more value than the price that they're paying. So this means that we want Seagate to be repurchasing its shares when it's trading for below its intrinsic value. And it's attractive to do so compared to some of the other opportunity costs that they would have. So because of their share buybacks, their earnings per share are up over this period, and this is a check on metric number 3. Metric number 4, we're looking for something very similar. We're looking for 5-year free cash flow per share growth. Unfortunately, this is not going to be the same result as our previous metric because their free cash flows, unlike their earnings, are actually down quite a bit over this period. So even with those 25% buybacks, their free cash flows are still down. Their free cash flow declines have actually outpaced those buybacks. This means that their free cash flows per share are down over the last 5 years. So this is an X on metric number 4. And so far through our first 4 metrics, we're split evenly, 2 checks and 2 X's. Next up for metric number 5, here we're evaluating how the business is utilizing leverage. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest potential risk of poor outcomes. So we want their net debt, which is their total debt minus cash and short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. Seagate ended fiscal 2022 with $5.1 billion worth of net debt, and currently they have $5.5 billion of net debt. And over the last 5 years, Seagate has produced about $6.4 billion worth of free cash flow. So this is enough free cash flow to be able to pay off all of this net debt within just 5 years. So this means that this is a check on metric number 5. It is worth being aware that over their last 12 months, they've only produced about $1 billion worth of free cash flow. So if we were to extrapolate their current free cash flows out into the future, it looks like they'd be using just slightly more debt in their business than we're necessarily comfortable with. So for them to be able to support this debt load going forward, they'd likely need their free cash flows to pick back up and get back to closer to where they have been historically. Even still, on a historical basis, this is a check here on metric number 5. And so far through our first 5 metrics, we have 3 checks and 2 X's. Our 6th and final metric, the big metric of them all, we want their average free cash flows to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a potential risk premium to the rate of the 10-year treasury yield and potentially give us another reason to be interested in Seagate. We're using their total enterprise value here to give us a more accurate economic picture of the business that's going to be more similar to as if Seagate were a private company. Total enterprise value takes into account both their market cap and their net debt position. Currently, they have a $16.5 billion total enterprise value. And we learned that over the last 5 years, Seagate has produced about $6.4 billion worth of free cash flow. This means that in an average year, Seagate is producing about $1.3 billion worth of average free cash flows. And so when we divide their $1.3 billion worth of their average free cash flow by their $16.6 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of 7.8%. That's more than double the rate of the current 10-year treasury yield, and that is above that 5% mark we're looking for. This is a check here on metric number 6 based off their historical abilities to grow their free cash flows. So similar to their last metric, over their last 12 months, it's worth being aware that they've only produced $1 billion worth of free cash flow over their last 12 months, which again is down from where they have been historically. So to get a current free cash flow to enterprise value yield for the business, when we divide their $1 billion worth of their last 12 months of free cash flow by their $16.6 billion total enterprise value, that gives us a current free cash flow to enterprise value yield of approximately 6%. So while that is a little bit below where their average free cash flow to enterprise value yield is at, that's still above that 5% mark, and that's well above the rate of the 10-year treasury yield. So both on an average and a current basis, it looks like Seagate is offering us a potential risk premium here. And this is a strong check on metric number 6. This doesn't mean that you're necessarily going to run out and buy the business. This This is just 1 out of 6 of our metrics, and this analysis is meant to be taken in holistically. Then here we're taking a look at Seagate's dividend profile. So currently Seagate is paying out a 5.1% dividend yield, which is again much higher than that of a yield you'd be getting from an S&P 500 ETF currently. However, people make mistakes all the time by blindly chasing dividend yields, so it's important to stop and look at the fundamentals of a business and to determine whether or not that company's dividends are well supported by either their earnings or their free cash flows, depending on the type of business. So for Seagate, we want to make sure that their dividends are well supported by their free cash flows. So Seagate, partially because of their buybacks, has grown their dividends over the last 5 years. They produced more than enough free cash flow in all 5 of these years to be able to comfortably pay out and support this dividend. And even with their recent declines in free cash flows, they still have more than enough to comfortably pay this dividend. Again, this is a snapshot based off their last 5 years worth of performance, and this is no guarantee for the future, but it looks like Seagate's abilities to continue paying out this high dividend yield would be dependent on how their cash flows perform into the future, but even with their recent reductions in cash flows, they're still able to support their current dividend. Then finally, we're using a discounted cash flow model to come to a potential fair value for Seagate. So starting with an average of their free cash flows over their last 5 years, so again, this is above where they're at currently. Then projecting their average free cash flows out into the future to give us an estimated baseline projection going forward. These estimates are based off of their historical abilities to grow their free cash flows since 2000. So it's up to you to do the work to determine whether or not these are potentially accurate and applicable going forward for Seagate. So assuming a growth stage over the next 10 years where they grow their average free cash flows at a rate of 2% annually, then assuming a terminal stage for the 10 years out after that where their growth is completely flat and the business stagnates. We're not adding in their tangible book value because that's significantly skewed based off how the accounting is done for their share buybacks. Then if we're looking for a potential 10% rate of return going forward on Seagate, it looks like a fair value for the business would be about $47 per share. So that's about $7 below where their stock price is at currently. Keep in mind that this 10% rate of return would be including their dividend payouts. And again, currently Seagate is paying out a 5.1% dividend yield, so we would not be doubly counting dividends here. Using these same historical growth assumptions from today's valuations of Seagate, it looks like you could reasonably expect about an 8% rate of return going forward from the business, with that same caveat about their dividends. Keep in mind that a discounted cash flow model, just like any other model in any other discipline, is going to have its outputs be very sensitive to its inputs. It's up to you to do your own homework to determine whether or not these are potentially accurate and applicable going forward for the business. Additionally, this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decisions, please consult with the properly licensed and registered legal and financial professionals. There are a number of reasons why this could potentially not be accurate going forward for Seagate as a business. You ultimately just want to learn more about the business to be able to find that out. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So in summary, Seagate checks the box on 4 out of 6 of our metrics. They're earning average returns on capital that are in the mid-20s. However, even with high returns on capital, they have seen both their top and their bottom line numbers go down over this period. Their revenues are down slightly. Their earnings are down a little bit, but basically flat. And most importantly, their free cash flows have fallen by more than 40% from where they were 5 years ago. At the same time, however, Seagate has repurchased about 25% of their shares outstanding. So they bought back a quarter of the company over this period, meaning that if their free cash flows were to potentially rebound into the future, that could potentially be a really good thing for existing shareholders, as their ownership percentage in the business would have increased by quite a bit. Then from a historical basis, they've produced enough free cash flow to be able to support support their current debt loads. But if we were to extrapolate their current free cash flows out into the future, they'd have a little more debt than what those cash flows could support. Additionally, on both a current and an average basis of their free cash flows compared to their enterprise value, it does look like Seagate is potentially giving us a slight risk premium to the rate of the 10-year treasury yield, so it could be worth your while to dig in and learn more about the business. Taking a look at their dividend profile, it looks like their dividend payments are well supported by the abilities of the company to produce free cash flows, even with their recent decline in free cash flows, assuming that those don't continue to decline. And finally, performing a discounted cash flow analysis of Seagate, using the assumption that their free cash flows are able to get back to where they have been on a more normalized average basis, then it looks like from today's valuations you could reasonably expect about an 8% rate of return going forward from Seagate if you believe that those historical growth assumptions are going to accurately reflect the business's potential future. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. Instead, this analysis serves as a beginning and holistic understanding to help you determine whether or not it's worth your time to dig in and learn more about Seagate. As a value investor, you're ultimately trying to conduct your research as if you're going to own 100% of a business, and you can truly understand the essence of that company and understand what's important and what's not important for the business going forward. Through this deeper research, you're ultimately going to be able to learn more about the qualitative and the quantitative aspects of the business, and you'll likely be able to determine for yourself what a potential intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Seagate Technology Holdings PLC, ticker symbol STX. Again, Seagate was a subscriber request and they're currently paying out a very high dividend yield, so I'm happy to make an analysis of the company. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Seagate with me, and have a great day.